One thing that I struggled with at the beginning, and that also a lot of my friends who get into investing struggle with, is how do I find a stock? How do I analyze it? So today I just want to take you through my thought process of how I find stocks, how I analyze them, and what I watch out for. There are mainly two ways how you find stocks. One, you just stumble across them. I'm online a lot, I'm on Twitter, I read a lot about stocks there. Sometimes I even see a company, IL, and I think, hey, I didn't see this company before. A lot of my bigger investments, like Alibaba, like Meta, came from just me knowing about the stock and looking into them at the time. That is way number one. That is way less reliable, but it is a good way to find stocks. So just be open-minded. When you see people talking about a stock, look into it. That doesn't mean it's good, but it's always nice to expand your horizon. Know more companies, learn more. Now, what is the second way? Here, for example, we have a stock screener. I use stock analysis because I just think it's the best value for your money, and I just find the UI really good. You can use other stock screeners, but I just prefer stock analysis. For example, let's say you really care about dividends. So we take dividend yield, for example, and say above 5% at least. I only go for heavy dividends. But well, a lot of dying companies just pay out a dividend, so let's also take a bit of revenue growth. Let's say they should have grown revenue by at least 2% per year to around match inflation. Over the last times that has not really been the case, but let's say this is just the case. And then we could also say, okay, I want the company to be at least profitable. For example, we take earnings per share of over 0. And we have 165 stocks. What you're always gonna know is there's gonna be a lot of like one-off companies at the time. For example, the oil and gas sector has done very well the last few years. They have paid very high dividends. Shipping can also be very volatile. Take away all the oil companies, take away all the marine shipping, asset management as well, because they are highly volatile. And now we're left with a bunch of different companies in different industries that might be interesting. For example, let's go Grey Media Inc., trading at a 2.5 PE ratio and an 8.2% dividend yield, historically growing revenue at 13%. Doesn't sound too bad, doesn't it? Owns and operates television stations and digital assets. Alright, we can see ever since 2021 they were crushed. That has just been how all the television companies have been. CNN, Fox News have not performed well. Revenue has performed very well, though. Also, the company didn't do too much dilution, but they took on a huge amount of debt. So, for my first indication, what do we probably have here? Probably a cable TV business, which took on a lot of debt, acquiring all channels, and now slowly is getting hit by the slowdown in television. Now, what would we do if we find it at least a bit interesting to look at? Because I don't find this too uninteresting to look at. Great dividend yield. Good profitability over time. Of course, they have down years, but overall they're profitable. And currently heavily reducing debt. So what would we do now? We would go into the investor relations. Some companies have more extensive investor relations and presentations. For example, if we look into it, just for how the company is performing, core advertising growing at 1%. Of course, we would have to look over multiple quarters to see how they're doing. Retransmission constant revenue, 2% decrease. So overall, the business is kind of staying even right now. However, political advertising grew 565%. Makes sense. The US had elections, so a lot of money was spent on advertising. So this is going to be a one-off quarter probably. And maybe we can see, for example, what are they focused on? They're mainly focused on paying down their debt. And also what they often have is an investor deck, which is usually just showing you what the business does. We can see when the debt matures, we can look into that. But overall, this is how I would get a quick glance at the company. Then I would read a bit more into it, look into the news, look at their assets, what do they own, what are their competitors, and also what is in the news about them. Seeking Alpha is also a good source, however it often costs money to read the articles after some time, so I don't use it as much. And this is how you slowly get an idea. And now why do I always say only look into it if you think it's interesting? Because there are thousands of stocks, and if you look into every single one, you're not gonna find one. Stocks should be really like this. Does this look like a buy? Look into it. Otherwise, pass. There's no shame in putting something on the too hard pile. For example, I don't get this company, or I just don't see it as interesting. That is fine. Let other people buy the stock. There are thousands of stocks. You missing out on one stock is not gonna change your life. And if you look into every stock, you're not gonna find that one stock that is such a great buy for you. And that is one of the ways to find a great company. Now, this is just an example. I'm not saying buy this company, but then you should look into it. And then the valuation difference from company to company. Here we have a company which bought a bunch of assets. You can see they did giant acquisitions. And now they're focused on paying down this debt. Now, so what should we think here? Are they going to be able to pay down this debt? When are they going to have it paid down enough to return to shareholders? And when is management going to say they're going to pay money to shareholders? Because if we look at it, last quarter, in net debt, they repaid 400 million. That is the entire market cap. So that is a very interesting play. So then you look deeper into that. You listen to the earnings calls. Then you make your valuation. And then you take a conservative estimate. If you want to see some examples of how I analyze stocks, for the stocks I cover, I always put a valuation at the end. So just look into that if you want to see how I value the stock. And remember, this is different from case to case. And also here, if you do not know how to value a company, skip it. It doesn't matter. I often do not know how much should I pay for this. And then I just say I'd skip it. So this is just a way to look for stocks. A fairly simple and easy way. And you can tweak this for any kind of thing. Are you more interested in growth stocks? Go away from the dividend yield. Go to revenue growth 20% CAGR. Maybe with a PE ratio of under 40. And then go with that. If you see some things like marine shipping again, and you don't want to look into all these tiny things which are exceptions, mark them out. This is just how you go. From a case-by-case basis, what do you want to invest in? What is your investing style? That is already what you should kind of know. A dividend investor should not buy Mercado Libre, for example. A stock I own, growth stock from South America. That is not something they own. But for example, a person buying Amazon is not gonna buy British American Tobacco. Go through the companies. What I did for this one company. Quick overview. Does it look interesting? Now, am I gonna say that is the only way to look at stocks? No. But however, it is what I think works for the majority of people. It works for me, it works for a lot of the friends I showed it to, and I feel comfortable investing like this. And if you're not a person willing to dig through dozens and hundreds of stocks over the term of your lifetime when investing, buy ETFs. There's no shame in it, there's nothing wrong with it. Do you have any tips? Write them down in the comments. Have a good day.